Hey, what's up, everybody? This is Brandon from The Collective. Super excited about what's about to happen here for all of you, myself included. I have got an old friend of mine that I respect greatly, that's had a tremendous amount of success in the mortgage world with us today. And it's going to be a great, valuable few minutes for you. Make sure you watch this whole thing in its entirety. And then the people in your network, tell them what you heard here today. Invite them back to get more of this information because today we're all going to get better. We're going to get a little smarter. I'm excited to share this with you guys. So Sam Wax is a good friend of mine. I met him. Man, let me just pull him in here. Sam, we met. This goes back probably
Long
to
time ago.
yeah, like, well, I bought my first house in Florida in '97, investment house. So I knew you back in the late '90s. And so that puts us over 2 decades. That's crazy. That is absolutely nuts.
I think I
Uh,
met you around the same time as that investment group that was that started off at that little Chinese restaurant, and there were like 5 or 6 or 7 of us, and then it got bigger and bigger. So at that point, it then became it had to move to another restaurant, and then eventually it became like Piccadilly Cafeteria, where there's like 200 people showing up hearing
that's
investment
right. That
pitches.
That was before the power of social networks and social media, where we had to actually get in a car. If we wanted to network, we had to actually drive somewhere to network. It was powerful. It still is powerful. Sam owns My Easy Mortgage, and it's not a little organization. It's a big. Sam, you're licensed in a lot of states, aren't you? Can't you write programs in a lot of states?
17. 17,
17
up
of
and
them.
down the East Coast, up until, let's see, Florida, Georgia, South Carolina, North Carolina, Virginia, Tennessee, all the way out in California, Colorado. We've hit most of the bigger states. We've got Texas, Michigan, Pennsylvania. So it's fun during continuing education time. It's exciting. It takes me about a week to do all my continuing education, but it's worth it. It's worth it to be licensed in that many states.
Well, I'm proud of what you've accomplished, and I'm
Thank you.
super excited that we've reconnected again for a lot of reasons. And I had a conversation with Sam a few weeks ago, and I'm like, hey, I'd love for you to be able to share some of your knowledge with my network because I know you can help them tremendously. So, Sam, I want to jump into this immediately and talk about kind of the hot topic in the loan world, and that is interest rates. Like, it's a dominating conversation. It seems as though every time we turn around, it's either gone up or we're hearing it's going up some more. So what are you seeing? What are you hearing? Where do you think it's going? I know you got like this,
The
you
crystal
got this
ball.
Notre Dame thing going on. You know exactly what's going. No, I'm kidding. I'm kidding. But what are you feeling? What are you seeing? What do you think?
So there's a saying in real estate that date the rate, marry the house.
Date the rate. I like that. Date
Date
the
the
rate,
rate,
marry the house. I
marry the
like
house.
that.
As long as you're buying the property for the right price and it fits your needs, whether you're buying a first home, second home, investment property. Um, another saying, you know me, I'm full of sayings. You won't get appreciation on a house you don't own. So at the end of the year, if you're currently renting and rents are only continuing to go up, um, what do at the end of the year you're renting? What portion of that property do you own? Do you have any equity built up, or did all that money go to your landlord?
Right.
Um, so, do I know where rates are going to go? No. Anybody tells you that they do, they're full of it. But um, back when I first met you, I think rates were pretty close to where they are right now.
Yeah, that's what we
And
were talking about. It's a lot of investors have not been investing for 2 decades, so they only have a frame of reference of the last few years. So once upon a time, it was a lot higher than 6, 7%.
big time. And right now, we're still below the average. So the 50-year average of when Freddie Mac was keeping track of rates, we're still below it. Um, so do are we going to get back to where the threes or fours, or everything's cyclical? Any investment, as you know, goes up and it goes down. And the
Right.
idea is, but you're not buying the interest rate, you're buying the property. So if you
Right.
buy the property right, then that's really all that matters in this market. And there's still, it's easier today to get qualified for a loan than it was in the past. In my opinion, it's actually easier from a qualification standpoint. There's so many different programs out there, and your normal conventional FHA, VA, USDA, but you also have all of the what are known as non-QM products, which means that they're basically subprime for the people that have been around for a little while. Those those loan programs help the people that are self-employed and so on and so forth.
So, when you're first saying you date the rate and marry how's it go? Date,
Marry the house, marry the
marry the
property.
house, date the rate. So basically, we're talking about, guys, is at some point down the road, you probably will get a chance to refinance.
Yes.
And so we did that, Sam. We did that here, the house that we're currently in. In fact, it was a task to get refinanced. Like I think they wanted my blood, my wife's blood. Like it was crazy. Like I couldn't believe all the questions we had to go through and stuff, because I know how much equity was sitting in this house. But I am so grateful because our mortgage dropped over $2,000 because we refinanced. So that's going to come again, right? It's cyclical. So if it's high now, at some point, if you bought the house right, as you're saying, whether it's yours or an investment property,
Mhm.
you'll get an opportunity to refinance.
And sellers are willing to participate in a lot in today's market. To There's what's known as a 2-1 buy down. There's what's known as a 3-2-1 buy down, where a lot of sellers, depending on obviously finding the right property, finding the right seller, a lot of them are willing to pay for your rate to go down for the first couple of years to make it easier to get into the house and buy furniture and all the other things that are involved.
Yeah. So when the script gets flipped, meaning you go from a seller's market to a buyer's market, what happens, guys, is the buyers have more negotiation power. The buyer has the ability to ask for some things that you just couldn't ask for 18 months ago, or maybe even 12 months ago. That puts all of us in a position where you can end up getting the house at the price that makes it still a good deal. So, um, you
Sellers a
know,
year ago, not to cut you off, but a year ago, sellers were asking for premiums. So you had bidding wars going on houses where sellers are like, "Yeah, I like the fact that this guy is offering me full price, but this other guy is willing to give me a full price, plus is willing to give me an additional $25,000. Plus, they don't care what the property appraises for. Plus, the property is also we will accept only cash." Um, now, now the narrative's changed a little bit, and you've got sellers that are more willing to work with buyers and more willing to. Um, so your buyers that the sellers weren't looking at their contracts really hard at before. So your FHA clients, your VA clients, people that were putting down less money, sellers were looking at those and saying, you know what, I'm just accepting the cash offer in today's market, and not really entertaining those offers. Now, if you're an FHA buyer, you're a VA buyer, you're putting down less money, you've got a better shot at winning, getting under contract on particular properties.
yeah, yeah, it's interesting what's going on, and the point is, guys, that in anything, when things get a little bit more difficult, it gives an advantage to the educated, period, no matter what it is. As things get more difficult, people that have more education, more understanding are the ones that end up coming out and winning. And so things are getting a little difficult for sellers right now. They weren't before. So this is interest rates going up to me is exciting, Sam. It's exciting because 12 months ago, any investor could, or any seller could make money, and anybody that thought they were an investor could buy a house and 2 months later sell it for a profit. And they all of a sudden think they understand the game. And I'm kind of like drooling right now because there's a lot of people who thought they were investors who are about to realize they've made some mistakes and they needed some more education like that. To me, it's exciting where we're heading. So let's shift gears a little bit and talk about some of the you guys call them products, right? When we talk about different loans, you call them products. And so let's talk a little bit about some of the products that are out there because there's basically two type groups of people, right? There's someone that can prove their income or show their income. That's usually people that are employees or there may be some people out there that are 1099, but a lot of 1099, a lot of my audience, a lot of my 1099 people, they show as little income as possible because it's a tax thing, right? The more you show, the more you pay taxes on. And so we educate our people heavily, heavily that the smartest investors in the world are not paying 30% taxes. They're not even paying 25. A lot of the smartest money people in the world are paying like single digits in taxes, some even zero. It's crazy. We know that's a job. It's a full-time job to do it. However, a lot of our people don't show income. But I wanted to talk a little bit. Let's talk a little bit about the products that are out there. I know you've got some really, really great people that you work with that kind of specialize for investors that don't show income. So
Well, we'll bring Kyle on in a minute, but I want to give you a quick story about how I bought my house because I'm also self-employed. So this will probably be a good comparison for a lot of people that are on. I don't pay myself a lot of money. I love my credit cards and I love my miles. And my when we bought our latest house 2 years ago, August, I didn't qualify because I had another property. I didn't qualify for a traditional conventional loan. So I had another property that I had currently had for sale that I still had a mortgage on. I still had some credit card debt that I was willing to wait on to pay using the proceeds from the sale of the property that was still for sale. And so what I did was I did a 12-month business bank statement loan. So I had to prove out I did a 10% down loan using retirement funds at the time. So I withdrew retirement funds for 60 days, took the money out. That was my 10%. That took care of my asset portion. And I used 12 months worth of business bank statements, and I was able to use 50% of the deposits on those bank statements as my personal income, which made me super way overqualified for the loan, but rather be overqualified than underqualified. Easily qualified. At the time, interest rates were 3%, and I took out an interest rate of 6%. And I talked to some of my friends that are in the industry, and they're like, how did you get a 6% interest rate? Rates are now in the threes. Well, I refinanced after I got in. I took care of that barrier of entry of getting into the property. And once I refinanced into a 3% interest rate about 5 or 6 months after I bought the house. But I took care of buying the house at the price that I wanted to and took care of that barrier of entry of getting into the property. And then you could always refinance later on. So I'm a good example of somebody who's self-employed using a non-traditional lending product where I proved out my income using bank statements, and it all worked.
So you took the 6% because that allowed you, based on your income, to only put in 10%. So
Yes.
you put in 10%. So all those things, like you had to take the higher interest rate to get the deal done, but you knew going in that the interest rate wasn't the most important thing, that after a certain amount of time you could refi. So the 6% was just a necessary evil to get the deal done.
temporary, very temporary. And what I've done since then is I also took out a line of credit against the house that I was able to use because the house appreciated during that time. I Over the last 2 years, the house has appreciated ridiculous amounts. Um, and I was able to take out a line of credit, which I then used to buy an investment property that I'm going to be flipping in the next couple months. So uh, that property became an asset, but asset that I could use to do other things.
Beautiful, beautiful. So yeah, let's talk. Let's talk to Kyle a little bit. Let me bring Kyle in. Let's talk about. Hey, Kyle, how are you?
Hey guys, good morning.
Good morning. Good morning,
Good
Sam.
morning.
Introduce everybody to Kyle.
So Kyle Miller has been with me for 3 years now, something like that.
Yeah.
And he was in the mortgage business before 2000, in the 2008 2009. Before then, but he has been phenomenal. His main source of business has been investors. He works with and he's closed. The reason I wanted to bring him on, he's closed more DSCR loans, which are debt service coverage ratio loans, than anybody else in the company. So he's an expert at it. And Kyle's best attribute is he is stubborn and he knows the guidelines. So that's the key with any loan product, is really digging in and knowing your guidelines to know, is this, before you run through the gauntlet of trying to get approved, does your loan officer, and I know we're going to talk about this later, but doesn't your loan officer actually know their products?
Yeah.
And Kyle does.
Yeah. So Kyle, if you qualify, you can go out and you can get a mortgage, right? And you can then probably get an investment home based on income. But at some point, banks stop wanting to lend you money based on purely, your debt to income ratios. But as investors, we don't want to be handcuffed, right? We want to be able, if there's a deal out there, we want to go put deals together. And so this program that Sam was just talking about, let's talk about that a little bit. What do some of those programs look like? Let's say there's a $400,000 investment property that we want to get in, but we can't qualify for a conventional loan because of debt and income ratios. So what's out there? What type products are out there for people who want to be active investors, can find good deals? They just need to find the money.
So, like Sam was saying, with the non-QM or subprime market and what's been going on, there's a lot of new programs that are coming out and that are on the market that help to qualify investors. Most investors have the same problem that we all have. We're all self-employed and we all write off whatever we can write off to reduce our tax costs. So if you can legally write 90% of your income off, you're going to. It just makes sense. So instead of maybe not doing some of those things and taking advantage of those tax breaks, is what the lenders are doing is they're offering different ways to basically identify or give you a source of income that they can grade you on. So one of the new programs that's out there is DSCR, or debt service coverage ratio. And the idea behind it is, instead of you showing tax returns, bank statements, how much money you made, yada, 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 is realistically the only thing they're concerned about is what the property brings in as far as money and what your expenses are. So if your current lease on the property, or the lease from the rent roll on the appraisal, if that number is the same or more than what your principal, interest, taxes, and insurance payment would be, then they are looking at it as the property is bringing in more money than what your expenses are to pay this payment. So they don't necessarily have to worry about any of your other expenses or any of your other income, is because the only one that they're concerned about is this individual property.
So what's happening is, instead of an individual and their income having to be what qualifies you for the loan or not, now it's the actual property that's
correct.
qualifying, correct?
Yeah, so the only thing that you're providing on this side is they're going to want to see your credit report. They're going to want to see that you do have a history of paying bills and making your payments on time. That's that risk factor. And then the only other thing is they're going to want to see some reserves. So these are assets that you hold, whether they're liquid or non-liquid. It's just a way that they're reducing their risk, knowing that, hey, if something comes up. You can afford to fix it. You can afford to make a couple payments if the rent's not coming in, etc. So
Yeah.
so basically, instead of them qualifying you, like you said, is they're just qualifying the investment.
Yeah. Yeah. And guys, just so you know, here's what I love about real estate. The loan that Kyle just talked about. You get this thing going, you get it cooking, you probably improve the property a little bit. And in doing so, you can increase the rents to bring them up to fair market value. And when you increase the rents, that makes the property value go up. And when the right time comes, you can refinance this property based on the new rents, right? So now the property's worth more money. So let's say you bought it for $1 million, um, or it has a value of $1 million based on its rents, but because you've been able to come in and improve the property, let's say a year or two from now, it's showing that it's now worth 1.5 million. Here is one of the things I love about this conversation. That $500,000, guys, when you refi, you can pull that money out. That $500,000, so you get it now financed for 1.5. That 500,000 you pull out is 100% tax free.
Yeah.
100% tax free. You can take that 500,000 and do another deal with Kyle and Sam. That's your money. That's the money you needed to put down on the next property, and you keep rolling. It's phenomenal, phenomenal, phenomenal investment.
When your money makes you money, that's the way of the world. So, and not necessarily, and when it comes to investing too, is you could be a big time investor, but you only know what you know. For example, I'll call my guy Mr. Smith. I have a Mr. Smith investor who I made contact with through a realtor friend of mine. The next thing we start talking, and he's letting me know that he's got like 65 different properties in Pinellas that he rents. I was like, oh, that's awesome. Like, congratulations. We started talking about loans. Come to find out that 90% of his loans that he gets are hard money loans, because those are the easiest way for him to qualify. They're super fast. You're paying a higher interest rate and you're paying some more points up front. But at the end of the day, that's not what's important to him. What's important to him is getting his investment at the right price. Well, after about a 30-minute conversation with him, and we realized that at this time, this was last year, is we were doing these type of loans like in the fives. And a normal hard money loan is typically 12%. Well, you can do the simple math to realize how much money we have saved him over the last 12 months. He's going to name his firstborn kid Kyle, 100%.
That's funny. That's funny. That's funny. Hey, so final question. Let's talk about when these guys go out and they start looking for someone to work with. A lot of people think they just have to go to Bank of America or Wells Fargo and walk in the front door and say, I need a loan. But there are folks like you guys that are educated, that have the best interest of your investors or your people that are working with you, because these are products, right? So these products are out there. What should these investors be looking for when they're working with someone? Like, what's some of the things that will let them know that I'm working with the right people to help have my best interest at heart?
So the first thing is yes, you can go to your local bank and they may have an option for you, but your local bank only has the options that they carry. As a mortgage broker, we're signed up with 75 different lenders. So, and we specialize in the stuff that your bank does not specialize in. Most banks don't want to have anything to do with any type of non-QM bank statement loan. That's not their cup of tea. They like the cookie cutter W-2 employee, comes in, been at the bank for 15 years. That is their customer. So what you want to look for is you want to look for somebody that's going to do the work for you. So using a broker, and especially a broker who specializes in whichever side of the business you're on, whether it's an investment side or if you're looking to buy a first-time home buyer side. If they're specialized in that area, they are going to bring the most value to your portfolio as far as what programs you have, and you're going to know the fact that you're working with somebody whose their job is literally to find the best deal for you, whereas your bank's job is just to get you to sign these papers.
Yeah.
That's a great point. Brandon, a couple other things to bring up. One is experience. So if you go to a glorified teller at a bank or a credit union, a lot of them don't own homes. So you're asking for advice on what mortgage should I use from somebody who's not really a homeowner. You know, Kyle's been a homeowner for forever. I have as well. I've been doing this for 28 years in the lending side. So you're getting real experience. You're getting all the products that Kyle just mentioned. And you're also getting speed. So when you're making an offer to a seller, the seller wants certainty that your offer, that your approval is good, and they want to make sure that you've got, and we can provide really fast certainty. So our pre-approvals are really accurate. We go through a 77 bullet point checklist to make sure that your loan's going to work before it really gets going. Figure out what are the problems before the problems come up. And then the other big thing is just having speed. So we close some loans in 2.5 weeks, 3 weeks. So that gives you bargaining power with the listing agent and with the seller of, hey, look, they're gonna have they got their act together. They can close quickly, so that you don't have to wait for something wrong to happen, which is always a possibility. So we want to provide that early certainty.
So what I'm hearing you say is look for someone that has the availability to find the right products for you, not telling you what products you need to take, kind of listening to you and then saying, here's what's available. That's number one. And if it's taking weeks and weeks and weeks to get information, you probably are not working with the right people. Like if it's taking forever to get pre-approvals or things, it's probably not the right people.
Silence from your loan officer is usually a bad thing. Like that's not what you want. You want constant communication to know that you're on the right track and that your loan's going to go through, and you can schedule your movers, you can buy your appliances, you can do things like that. You're not held back by anything, which is so important.
Yeah. So to wrap this up, if the audience here has some questions, they want to reach out, they want to connect with you guys, give them a couple channels. Like, should they hit you up in the socials? Should they find a website? Where is the best way to connect with you guys?
We've got multiple. We've got myeasymortgage.com, MY, easy spelled out, EASY, mortgage spelled out.com. You could always email Sam at myeasymortgage or Kyle at myeasymortgage. We're both on the Faceagram and the Instabook and all the social media stuff. We've got. You can even contact me on LinkedIn if you want.
I appreciate you guys being on today. And Kyle, it's nice having you on here with us, getting your expert opinion. And Sam, always a pleasure to chat with you. We'll do it again in the future. We'll pick some other hot topics and to help this audience out. But thank you guys for being on today. I really appreciate it.
Our pleasure. Thank you very much for having us.
Yeah, it was a lot of fun. Thank you.
Yeah, man. Talk to you guys later.